What's up, everybody? Welcome back to another 10-minute Thursday. And in today's 10-minute Thursday, I want to talk about a safer play. In recent videos, I've talked about riskier plays. So in today's video, I want to bring you a stock that has relatively low valuation, good dividends, and great growth prospects. And that stock has the ticker symbol PARA, or P-A-R-A. They were recently called ViaCom, but just changed their name this past earnings to Paramount. Just a quick side note that none of this is financial advice, and you should always do your own research before investing. And with everything that's going on in the world right now, please be extra careful where you put your money. So as of today, Paramount Global currently sits at $28.08 after hours. It has a market cap of roughly $18.5 billion, a PE ratio of 4.29, and a dividend yield of 3.38%. In case you don't know what a dividend is basically the distribution of some of a company's earnings to its shareholders. So basically think of it as recurring income that you get from the company for holding its shares. Now let's calculate how much you'd earn for holding ViaCom shares. Formula for the 3.38 dividend yield percent is equal to annual dividend per share divided by the share price. So to find the annual dividend per share, you would have to multiply 0.0338 times 28.08, which is the current share price. And this gives you 0.949 or 0.95, let's say. That means that if you were to hold one Paramount share for 1 year, you get $0.94 for holding that share. And the PE ratio is a metric used by many investors to figure out whether the stock is either overvalued or undervalued in the market. To calculate the PE ratio, you divide the share price by the earnings per share. Now, what is earnings per share? To calculate the earnings per share, you simply divide the company's profit by the number of outstanding shares it has. Paramount has a PE ratio of 4.3, but if you look at the industry average for the broadcasting, media, and cable TV industry, the average PE ratio as of the fourth quarter of 2021 is 27.12. So in terms of that metric, Paramount is severely undervalued compared to its peers. So a little bit about the company. Paramount delivers premium content to audiences across platforms worldwide. Their brands are number one in key US target demos, including total audience, kids, adults, African Americans, and Hispanics. Some of the platforms they own are Pluto TV, Paramount Streaming, Comedy Central, Nickelodeon, and CBS. If any of you have watched the Champions League, you know that CBS puts out highlights of each game right like 10 minutes after the game is done. Now let's look at their earnings, their balance sheet, and their income statement. So total company revenue increased 16% year on year in Q4, and quarterly global streaming revenue increased 48% year over year to 1.3 billion. And they also added a record 9.4 million global streaming subscribers led by Paramount Plus to reach over 56 million subscribers in the quarter. If you followed Paramount for quite a while or Viacom, you know that they're relatively new to the streaming business, and to achieve this kind of growth in such a short time is truly amazing. They also generated $2.3 billion of cash from selling non-core assets that they no longer needed. Their total revenue for 2021 was $28.5 billion. This sheet is not in the thousands like in other 10-minute Thursdays. This sheet is in the millions. So they're $28 billion in revenue. Imagine that. They have a revenue higher than their market cap right now. So the total company revenue was up 16% year on year. Streaming revenue was up 48%. Streaming and subscription revenue was up 84%. And streaming and advertising revenue was up 26% for the year. Now in Q4 of 2021, they did add 32.8 million subscribers to Paramount Plus, but the one thing they don't say in this earnings report is that if you're subscribed to T-Mobile, you get a 1-year free Paramount Plus subscription on T-Mobile. So quite a few of these subscribers could have been from T-Mobile, and we don't know the exact numbers as it isn't reported in this report. They also streamed the Super Bowl and also have their own hit originals like Dexter, New Blood, and Yellow Jackets, and also produce their own movie, Jackass. Now, I haven't watched any of those, so I can't really give you a review on how good or bad it is. but it really increased their engagement and their subscriber growth in this past quarter. They literally have 3 segments to generate revenue: TV entertainment, cable networks, and filmed entertainment. Year on year, revenue grew in all 3 of these segments by at least 17%. If you look at their income statement, revenue has gone up from 2020 to 21. Although their expenses have gone up, they've also diversified their portfolio and entered the streaming business. Their net profit for 2021 was $4.5 billion. Now think about a stock like Palantir. And I know Palantir is like a super hyper growth stock, but Paramount literally has a lower market cap than Palantir and generates $4.5 billion in profit in 2021. Now the reason why the stock is held back so much will perhaps present itself in the balance sheet. If you look at the amount of cash the company has, it grew from 2020, which is 2.9 billion, to 6.2 billion in 2021. Everything in their assets looks good, but if you come to their liabilities, you'll see that the company has $17.7 billion in long-term debt. 2 ways that they could reduce their long-term debt is by issuing more shares or by reducing their dividends. Now I'm not really sure how they're going to do this, because you can see they don't have enough cash to pay off all their debt, and they'll need that cash to reinvest into their streaming business. But this is probably the reason why the stock is so held down in the market. When Netflix reported their Q4 earnings of 2021, the reason the stock crashed was because they reported that they were losing a lot of subscribers to other streaming services, and one of them was Paramount Plus. Although the company did pay off around $2 billion in its long-term debt, it still has a lot of it, and that I believe is the key for the company's success in the future. If they can continue to pay off this long-term debt in 2022 and 2023 and grow their streaming service platform, I can see this company as a value company and a growth company at the same time. If you look at the institutional ownership, you'll see that the company has 67.52% institutional ownership, which is a substantial amount. So these are some of the largest quarterly institutional transactions as of Q4 2021. We can see that HSBC Global Asset bought 8.3 million shares, Bank of America bought 3.3 million shares, and T. Rowe Price Associates bought 4.6 million shares. And these are some of the biggest decreases in positions. You can see Managed Account Advisors sold out in 4.9 million shares, 2 Sigma sold out in 2.7 million shares, and Glenview Capital sold out in 2.7 million shares. There have been some rumors of acquisition of this company because it's so lowly valued right now. There have been rumors of companies like Apple or maybe even Netflix taking over Paramount. For Apple, this would be a major play for them to enter the streaming industry, and for Netflix, this would help them make up their subscriber losses. But these are all rumors and nothing is concrete yet. So let's get into the technical analysis of this stock. Now, as of the day of the earnings, the company was trading around $36, and after it reported earnings the next day, it opened at around $28.5. So it lost around more than 20% overnight, and that was a pretty big blow from the company. But you could see throughout the very same day they reported earnings, they actually made a pretty good comeback and went all the way up to the high of $30.46. But due to the market pulling back and the widespread fear in the market right now, the company couldn't hold this uptrend momentum and pulled back all the way back down to 27.65. And for now, it seems to have settled between the $28 and the $29 mark. The stock price is currently sitting exactly at the 200-day moving average. So if it was to break below this moving average, then consider it bearish, and the 200-day moving average would then act as resistance. The RSI is also approaching oversold territory and is at 38 right now, so you could see a slight uptrend soon. You can see, despite the stock market not doing well in 2022, that this company continued to show strength during these weak times. So with all the chaos that's going on in the market right now, I definitely think if you slowly want to start buying a stock, that Paramount is definitely a good stock for you to start buying. At 4.3 PE, I really can't see how much lower it could go. Perhaps only around like 10%, but the upside over the next few years is definitely more than 100%. and this upside is just to get to a fair valuation. But don't quote me on any of this, you never know what could happen. But if you want a safer play, then Paramount is definitely a move for you right now. You can just look into it and have a strategy for yourself in order to maybe dollar cost average into the stock. Regarding dollar cost averaging, that's actually the most consistent way to make profits in the stock market, and I'll talk about that in another video. But anyways, let me know what you think of Paramount in the comments. Do you think that the stock is a good value play right now in these current shaky conditions, or you think that the long-term debt it has is unpayable and that the stock will never recover? Please like, comment, and subscribe. And that's it for today's video, and I'll see you guys in the next video.